Fred, I feel like I'm doing something wrong. I've been investing since the TFSA launched in 2009, reading charts, watching news, trying to find the next big winner, and I'm nowhere near $1 million. Meanwhile, you're telling me people are getting rich by being lazy. How does that even make sense?
It makes sense because they aren't gambling. People waste years hunting for the next Tesla, stressing over earnings reports and panic selling when the market dips. While they stress out, the lazy investors are quietly becoming millionaires. You don't need to pick unicorn stocks. You just need to stop picking losers.
I get the concept, but I've been investing since 2009, and I only have about $200,000. Is it actually possible to hit 1 million without working harder?
Not everyone makes it, but anyone who contributes consistently, invests early in the year, and uses low-cost index funds has a very high probability of success. You're struggling because your effort is going into the wrong place.
Okay, prove it. If I did nothing since 2009, where would I be?
Let's look at the math. If you had simply invested your full TFSA contribution room every year on January 1st into an S&P 500 ETF, your account will be worth over $465,000 today. And for US investors, the same simple approach inside a Roth IRA produces nearly identical results.
OMG, I didn't even get half of that.
Exactly. The S&P 500 returned more than 15% annually over these 17 years. You don't need to waste hundreds of hours hoping to find a 10x stock. You just need to stop sabotaging yourself.
I always thought getting to $1 million was impossible without taking huge risks. But you're saying the boring way actually works better.
Look at this projection. If you keep following this strategy for just 9 more years, the math suggests you could hit $1 million. Even with a more modest 8% return, you're a TFSA millionaire by 2034. And hypothetically, if you keep going without touching that money, you could reach $2 million by 2042. The same applies to US investors maximizing their Roth IRA. Both accounts grow tax-free.
That's incredible. I was thinking $1 million was a fantasy, and you're showing me the math for $2 million. But is it prudent to invest in just one ETF?
An S&P 500 ETF isn't really one thing. It holds 500 of the largest US companies across 11 sectors like technology, healthcare, and energy. It's like owning the entire US economy. If one company weakens, it's replaced automatically.
What about recessions or crashes?
A handpicked stock has a high chance of going to zero. The S&P 500 has historically never gone to zero. Since 1957, it has averaged 10.66% per year despite dozens of crashes. Your biggest enemy is not the market. It's your emotions.
So, the biggest risk is me panic selling.
Correct. The only time you need to be careful is when you're 3 to 5 years from retirement. At that point, I suggest moving 2 to 3 years of expenses into a high-interest savings account. This protects you from having to sell shares during a downturn.
I was spending 10 to 15 hours a week chasing stocks. And now I just need 2 minutes a year.
Exactly. And if you use those saved 10 to 15 hours each week to learn new skills, advance your career, or build a side business, you'll earn far more money than stock picking ever will. Maximize your income. Maximize your tax-advantaged accounts. Then invest the surplus in your regular taxable accounts. That's how people don't end up with just $1 million account, but multiple accounts working together. That's how you become a multimillionaire.
I never realized stock picking wasn't just costing me money, it was costing me growth in my career and my peace of mind. Fred, which S&P 500 ETFs are popular options?
You can look for any ETF that tracks the S&P 500 with a low fee. Here are a few popular examples. For Canadian investors, funds like VFV, ZSP, or XUS are common choices, all with a low 0.09% MER. For American investors, look at VOO IVV or SPLG, which are even cheaper at 0.03% or less.
So the secret isn't being smarter, it's being consistent, growing my income, and investing more. And with good quality, low-cost ETFs, I can manage my whole portfolio in the time it takes to brush my teeth.
Exactly. People think hype makes them rich, but in reality, consistency and staying invested is what builds long-term wealth.
Thanks, Fred. Now I can focus on not just becoming a millionaire, but a multimillionaire.
Here's my challenge to you. Check your screen time. How many hours did you spend watching stock predictions, hype videos, or moonshot picks this month? Now compare that to your actual returns. If you're ready for the 2-minute strategy, type multimillionaire in the comments below. And don't forget to like and subscribe so you don't miss the next lesson on building wealth efficiently.